Hello and welcome to Curious Futurist, the show that explores how today's technological and economic trends are shaping tomorrow's world. I'm your host, the Curious Futurist. Have you ever had this situation happen to you where you've been talking to somebody about something a little bit complicated, and after about 10 minutes or so, you suddenly realise that you haven't really understood what they've been saying to you? Well, much to my slight embarrassment, you're about to see this happen to me as you watch this week's interview. Now, what is this week's interview? Who's it with? Well, this week's guest is Berhan Kongel. He's the CEO of a company called ARF, based in Turkey. And what ARF is trying to do, what they are doing, is really trying to redesign and make easier the whole sort of international money transfer system. This is the system that banks and large companies use to send money internationally, say from dollars to Turkish lira or from euros to Hong Kong dollars and so on. And why does it need changing? Well, this is what we're going to talk about in the interview today. You'll see Berhan will discuss with us what the problems are with the current international money transfer system, why it's a problem for so many around the world. It's a bit too slow, it's a bit too expensive. And we're going to talk about how solving these problems could be a real boost for the global economy. And let's face it, we're all going to need this in the next few years, probably, as we try and get out of our current economic slump. This sort of change could be a real game changer for the world economy and the velocity of money. This is something we're going to talk about in the interview. So then we're going to talk about how Berhan got this idea after working as a digital entrepreneur for a decade in London, and how this is something that he decided was an important thing to try and solve some of the problems he was facing as an entrepreneur. So then we're going to talk about, this is the tricky bit, we're going to talk about how it works, what kind of cryptocurrencies are being used, because this is a solution that they're building on the blockchain. So you can see this is why it might be a bit hard to get some of these ideas. Berhan does a great job explaining it, but as you'll see, it takes me a little while for the penny to drop as we go through this. So these are the things we're talking about today, but we're also going to talk about how, with the changes that are going on with regulators, with banks, with attitudes towards money, you're going to talk about how in about 10 years' time, probably, all of us could end up having a completely different idea of what money even is, how we pay, what we use to pay, what we use to buy. We could end up even using the items that we win in a video game like Fortnite to buy a coffee in a local coffee shop. That sounds nuts? Well, when you hear Berhan talk about it, it all kind of makes sense, and he's got a lot of enthusiasm. So, are you ready to meet him? Welcome, Berhan, to the show. Nice to have you here. I just want to say, what you do at ARF, it could be a little complicated for people to understand. So why don't we start with the question of, what problem are you setting out to solve? So what is the problem? Why is this a problem, and who does it affect?
Yeah, sure. First of all, thank you for having me. And well, ARF is for me, this is my 10th year as an entrepreneur, and ARF is a particularly interesting product and interesting idea for me. It solves the problem, so-called the pre-funding problem that occurs when you want to send money from one country to another. Now, the problem is this. There are currently, in the traditional finance, there are two ways to send money from one country to the other. The one is, you want to send money? Sure. You go to your bank and you do a SWIFT to the other bank in the recipient country. So SWIFT is a very volatile infrastructure that came from the 70s, never changed. If you want to send money, you never know how much fees you're going to pay, because there are all these correspondent banks in between, this middleman, so to speak. And you are not sure about the time when the funds would arrive at the recipient account, the beneficiary account, I mean. So it's a very volatile infrastructure. So there is a hack for that, that financial institutions use to avoid SWIFT as much as possible. So what they do is, they go, if they want to open a corridor to a particular country from their own country, they first go and find a particular financial institution, and they sign a contract with them, a correspondent tie-up, so to speak. And what they do is, instead of pushing the transactions one SWIFT at a time, they push a giant SWIFT transaction to the recipient country, and whenever their users want to trigger a transaction to that to a beneficiary in that country, instead of using SWIFT, they use that account that they topped up in bulk to make a local transaction to the beneficiary. So that's a great solution, actually. If you look at it from operational point of view, it's a great solution. It works. Every transaction occurs in the same day or the next day. No SWIFT in between, no correspondent banking. It's all local last mile transactions. The problem is for the sending financial institution, they have to tie up money, a lot of money in the recipient country, in that what we call the pre-funding account or the nostro account in technical terms. So let's say if you are pushing that, pushing your operation to one country only, it's not big of a problem. You can do it. But if you want to expand to, say, 5 different countries, and in each country you have 2 different payout options, like cash payouts or wallet payouts or bank payouts, all of these accounts per payout needs to be pre-funded, and that's hell of an operation to run. And the money you have to tie up there is a lot of capex.
Okay. But when you say so we're talking about financial institutions here. So they have the problem of they need to send lots and lots of transactions, hundreds or thousands in a day to different countries. And this is a good system for them because it's convenient in a way, but it's expensive and there are some problems involved.
Yes, it's operational expense and a capital expense there because you have to manage all that money. You have to hedge it because most of that money will be in local currencies, and local currencies lose value against base currencies such as US dollar or euro. So there is a hedging operation, there's a payments operation, and there is a capex attached to it because you tie up all that money weekly or monthly or every 3 days, depending on the scale of your operation. So what we are saying is it's the 21st century. We have different technologies to solve for it. Why do you do that? So that's what ARF solves. It takes that operation and cuts out the pre-funding part of that operation. That's what we are trying to achieve or solve.
And so, do you have an example of the kind of client that you work with that you do this for?
I can't exactly name names at this point of time because of the NDAs we signed, and we are not exactly operational yet. We are pre-operation. We are in closed beta testing phase at the moment with a different different sort of many clients, so to speak, in many different countries, try and test out how our technology works. But the thing is, if you're a remittance company, I can name this. If you're TransferWise, you don't much have this problem at this point of time because you have $1 billion in funding and you can pre-fund as much as you like. And if you are that big, if you are close to a bank, so to speak, in size, you can do any pre-funding and you can buy a very cheap foreign exchange. You can do very cheap foreign exchange with a particular big bank at very good rates. But for every TransferWise, there are like 100 other remittance companies or mass payout companies that can't do that, that they don't have the resources to do that. They have the clientele to expand to those countries, but since they cannot pre-fund those countries, they cannot open those corridors. So what we are saying is, come to us, especially the European and UK ones at this particular point of time. So come to us. All you have to do is pre-fund our Euro and our GBP accounts, and we'll handle the rest. We will bring the correspondent tie-ups. You don't have to do business development, 6 months of business development. We already do that. We have a very easy to use API, like 20 lines of code that you have to integrate to your system. And we will give you a Euro IBAN, we will give you a GBP IBAN, and we will connect you to all existing railways like SWIFT, SWIFT GPI, SEPA instant, faster payments, and whatnot. And all you have to do is pre-fund those accounts in very infinitesimal numbers, like daily or every 6 hours, and we will immediately push the money to a foreign country, to the recipient country in that way.
So how are you able to do that so differently then? So at the moment, you'll have a company, they need to pre-fund a lot, They need to spend a lot of money on pre-funding, but through you, they don't need to do that. So it's still a kind
Yeah.
of pre-funding, but they don't need to do it so much. I mean, how does that
Yeah.
work?
There's still a pre-funding amount. You can't avoid that. I mean, mathematically you can't avoid that. But instead of $10 million, you can pre-fund like $500,000 because it's you can top it up every 3 hours, and you can use all that tie-up money to create new business, which is good for you. And obviously, it's good for us because you are now expanding to all these countries, and where your volumes are increasing to different parts of the world. So what we are doing is we are using the so-called stable coins and some other digital assets to actually move value, the actual value from one country to the other. So it's not exactly a ledger entry, but we are actually moving the value from the one country to the other. And stable coins are very fast and they are very liquid in most part of the world, especially dollar-backed stablecoins. So at this time, of course, we have to define what a stablecoin actually is.
Yeah, that'd be good.
It's a very technical solution, actually. I'll try to explain it as simple in layman's terms, so to speak, in plain English. So a stablecoin is a particular cryptocurrency. It's a digital money, so to speak, that is backed by a particular fiat money. So if you want to issue a stablecoin, what you do is you put $1 to a certain bank account, an actual bank account, and you create $1 worth of stablecoin in any blockchain. It could be Ethereum, it could be Bitcoin, it could be Tron, it could be a public blockchain, or it could be a private blockchain like Libra does. So for the stablecoin is a representation of that fiat money on the internet, basically, but a very, very peculiar kind of interpretation. So for example, when I send you a PDF file, I'm not actually sending the PDF file to you. I'm sending a copy of that PDF file. In our current databases and in our current digital infrastructure, we always create copies of files. That's what stablecoins do not do. That's the stablecoin part solves the problem solved, because money needs to be unique, right? You shouldn't be able to copy money. It's counterfeiting, right? So that's what blockchain solves. It makes sure that a created asset remains unique, and it's always unique if it is in country A, and if it's whether it's country B, it always remains a unique asset. It's not a copy of an asset. It's the asset.
So just to explain, then it's a bit like if you were to create a PDF,
Yeah.
but you could not copy that PDF. That was the only version of that PDF you could ever have,
Yeah.
and nobody will be able to copy it. Nobody will be able to counterfeit it or anything. Yeah.
When I'm sending that uncopyable PDF to you, it's no longer in my own Dropbox or in my own computer. It's now it only exists in your computer right now, or in your cloud solution, whichever you use. So that's the difference between a stable coin and a normal digital assets that we understand at this particular point of time.
Okay, so people can use stablecoin then is a kind of cryptocurrency on the blockchain, as you've said, but so what makes it stable? Because this is key to this working, right?
Yes. Well, there are two particular ways at this point in current time for a stable coin to remain stable. And from stable, what we understand is it's pegged against one base currency like US dollars. So US dollar is volatile against euro, but it's not that volatile, you know. And what makes a stablecoin different from a cryptocurrency like Bitcoin is its value doesn't swing, so to speak, based on $1 representation. So
it's not traded. It's not.
It is traded, and that's the whole point. It is traded, but the reason why you're trading it is not the same as you're trading Bitcoin. You trade Bitcoin to make money. You cannot make money off of a stablecoin. So what people are using stablecoin for to on-ramp to an exchange and buy Bitcoin. You know, so instead of using euros and dollars and other exotic currencies like Turkish lira, you buy stablecoin and you push it to an exchange to buy Bitcoin. So stable coins are sort of the money on the internet that you use to buy other assets, you know. So what we are trying to do, instead of buying assets, why don't we buy fiat money with stable coins? And that's exactly how our technology works.
Okay, so you're a kind of payment exchange kind of
Yes,
solution.
yes, we are basically connecting the traditional finance to the new age crypto finance or stablecoin finance, if you like. So what we are doing is, in country A, we buy the stablecoin,
Yeah.
which is stable, as the name suggests. It's pegged against $1 or €1. Its value usually never changes. So we buy that stablecoin, we push it over the blockchain to the recipient country, and we immediately sell that stablecoin against the local currency. It could be Hong Kong dollars, it could be Turkish lira, whatever. So all of a sudden, in minutes, it was euros physically in the European Union. All of a sudden, in a couple of minutes, now you have Hong Kong dollars in Hong Kong.
In a couple of minutes.
In a couple of minutes, yeah, exactly.
So this is the change, right? This because of the speed.
That's the speed. We are currently focusing solely on speed. How can I make this instant without the pre-funding? Because pre-funding is also instant. It could be set instant. You know, if it's same day, in the remittance business we say if it's on the same day, it's instant. So it doesn't have to be in seconds. But what we are trying to do is it should be in seconds, like sending a cat video over WhatsApp. You know, it should be that fast all over the world, globally.
Okay, so right now you're in a sort of beta phase.
Yeah, closed beta. Yeah.
So what does that mean then practically? So, I mean, you've got clients you're working with to develop this.
Yes, we have.
What are you waiting? What are you waiting on to sort of make it to take it to the next level?
Our approach requires us to become a licensed financial institution. That's what the trade-off is in these particular situations. You know. Because we are touching the funds. So we are taking that fiat money, converting it to stablecoin, pushing the stablecoin to the other country and converting it back to the fiat money, which sounds easy, but it's a lot harder than we thought when we started this out. But we are waiting for a license because we are touching the funds. But we are pushing pseudo money, so to speak, because we cannot push real money without a license. We are pushing pseudo money to all these various countries and looking at liquidity. Can we sell this stable coin? Which stable coins we should use? We are optimizing that technology at this point of time.
So so that's why it's like a testing phase. So I believe you've applied for a license already, I believe, is that right, for the Financial Conduct Authority in London?
We are preparing for that application. We are looking at the different, we are talking with law firms and regulators, because this what we are doing doesn't exist at this point of time. You know, it doesn't exist. So that combination doesn't exist. So we have to be able to explain it in layman's terms to the regulators that this is as safe as the traditional financial, but a lot faster, you know, and that takes a lot of time to explain this. I mean, we not only have to convince regulators, which are actually easier to convince, we have to convince banks and e-money institutions that we are connecting to our network, that this is safe and this is a lot faster and this is the future. So this takes more time than a traditional financial technology company does business.
And this is because it's new. No one has ever done this combination before, you said.
Well, it is being done, actually, not the way we are doing it. It is being done, and it's been tried before between two crypto exchanges, for example. Coinbase tried it, but whenever someone tries to do it, they immediately understand how difficult and how intricate and how complex that system is, and they usually give up. But we believe our system is much, much better and much, much more efficient than their solutions. So we are pushing this through. And we came a long way with all the regulators and e-monies and banks, and we are having a very positive conversation with them. And we are planning to start the actual live operation before the year's end right now.
Okay, so we're looking at, say, e-money transfers and banks. They're the potential clients, right?
Yes.
And then you're talking to regulators as well. So more than one regulator?
Right now, the English regulator, the British regulator, sorry,
Yeah.
sorry, the FCA, the Financial Conduct Authority.
Yeah.
But there are some more regulators that we want to talk to, but they will come in time.
So just out of interest then, the kind of feedback that you want, or I guess the better question is, what sort of feedback have you been getting then at this stage from, say, banks and from the regulator?
Well, at this time, it's a little bit complicated. The business model in its current form, they like the business model a lot. Because it makes sense. It makes sense from the user experience point of view, from the operational point of view, and from the unit economics point of view. So it makes sense. The problem is the quick switches between fiat money and the stable coins. So because nobody understands stable coins and blockchains as well as they understand fiat money, because they are very new. They are in their infancy at this point at this moment. And we are trying to explain how stablecoins work and how it is from one end to the other, from one user to the other user, very real-time auditable. So we are trying to convince regulators that the audits and also banks that the audits will be easier than it is today, because we are only using public blockchains and we are only using stable coins that have a lot of liquidity, because we have to be able to sell those stable coins to buy the fiat money from the recipient country. So we only use like 4 different stable coins at this time to make that happen, because they work in the countries that we are interested in. So those are all in public blockchains, and we are trying to convince those regulators that it's actually easier to audit transactions and easier to transaction monitoring, real-time transaction monitoring, if you put stable coins as much as possible into the chain of value.
Okay, so you're talking about the different kinds of blockchain then. So you're using public blockchains for this. So who would have access? Who would be able to see the transactions?
Everybody will be able to see. Everybody who is interested would be able to see the particular wallets as it is today and as it should be. Yeah. But we are isolating, of course, beneficiaries and end users from those particular transactions, because the stablecoin transactions actually happens between our accounts, ARF accounts. We buy them and we sell them. So the in-between is always ARF. So because it's a privacy issue, you don't want to see every transaction that you send to me, for example, viewed by all sorts of different people. You don't want to know, you don't want them to know how much money you have or how much you are transacting with. So that privacy in mind and regulations and compliance in mind, we are limiting those stablecoin transactions between 2 entities of ARF.
Okay, so only the entities involved will be able to see.
And in between the stablecoin transactions, so fiat money is coming to ARF. We are making the switch. We are pushing the stablecoin. We are making the switch, and the other financial institution is dispersing the money to the beneficiaries. So from the audit point of view, the regulator sees everything, because they have access to traditional finance. Now they have access to our stablecoin business too, because it's public, and we are going to be able to give them all our wallet IDs and our trading accounts all live in big exchanges like Binance, FTX, Luno, Bitflyer. We have all these trading accounts in those exchanges, and it's very easy to see the incoming and outgoing transactions even without our permission. So that's what we are trying to convince the banks and regulators, and we provide them the systems that they can audit all the transactions in between.
Okay, so it makes sense. So the banks involved can see their aspects of the transaction.
Exactly.
You'll be able, obviously, you'll be managing the transactions.
Sure, we are centrally.
The regulator can see the transactions. But like when we say it's the difference then between a public blockchain and making sure that there's privacy, I think now obviously this is a beginner question. How do you kind of ensure privacy on a public blockchain so that only those people who need to see it can see it?
Yeah, like I said, the stablecoin part, the blockchain part, only lives between two entities of ARF.
Okay.
So we are controlling those entities. These are two different trading accounts, two different wallets living in two different exchanges, one in the sending country, one in the recipient country. Both are ARP entities. So we are sending the money from ARP to ARP. That's the only public part of the entire transaction chain. So we are not publicizing people's transactions or companies' transactions. This part is for regulators only. Of course, it's public, but the public part is without the last miles, incoming money and outgoing fiat money. It doesn't make any sense. It loses the context in a public.
So people can't see who it is.
No.
They can
can't.
see a transaction, but they
Regulator can. The regulator can because they have access to the initial payment initiation in the sending country and disbursement in the recipient country.
Yeah,
but regular people don't have that access. Regular people only have access to the in-between stablecoin part. And we are sending the stablecoins in bulk. So not per transaction, but in bulk. Let's say every $10,000, every $5,000, every $50,000, depending on the volume that we are getting.
So in this way, you can guarantee the privacy of the transaction.
100%. 100%.
But also then the regulator can get all the audit data they need.
Exactly.
And I mean, presumably it would be, if anything, like more secure and more traceable, right, than what is done currently?
That's what we are aiming for. More secure, but more traceable. And more private.
It's so weird when you kind of just getting to terms, getting to grips with these terms, and it's like we're using a public blockchain but making it private. It's like, my brain.
Because you are isolating all the endpoints, so there is a bulk transaction in between, and you can't make the context to those endpoints. So you cannot trace it back as a public person. Of course, the regulator can, but as a public person, as a regular person, you cannot trace it back and forth.
Okay, so let's go in a slightly different direction then. So how did you develop this idea? Because obviously it's taken a lot of work.
Oh, wow. That's the story, man.
There have been some surprises along the way. So how did you come up with this idea in the first place?
Well, like I said, this is my 10th year as an entrepreneur, and before that, I had a company in the United Kingdom, and that was involved in social networking, dating, and location-aware apps. So we were creating basically services for different markets and all global markets. So and the problem was these apps were all cross-platform. You know, they lived on iOS, they lived on Android, but they also lived on web. So if you're creating a mobile app, a native mobile app, you don't have much of a problem in terms of payments. You know, if you are living on iOS, the in-app purchases handle everything for you with a 30% Apple tax attached, of course. The same goes for Google. They have their own payment system. You have to use it. But if you're creating the same service on web, now you have to onboard what we call a payments gateway that can process credit cards and can hold credit card data and can supply you with subscription payments. You know, that goes on every month. So the problem is, if you are, for example, doing a dating app, it's considered to be a very high-risk business. So if you're a high-risk business, you cannot work with big payment gateways. Like you cannot work with PayPal. You cannot work with Stripe.
Well, because it's seen as high risk.
It's seen high risk, and they don't serve businesses, high-risk businesses like gambling or on-demand businesses or dating or I don't know, porn. They don't serve that. So you have to go for gateways that serve that particular part of the market. But they are usually a little bit subpar gateways. Not subpar, but their technology is great, but their coverage is subpar. So they are either local or regional at best. So think about PayPal or Stripe. They are almost global, you know. So our market was like Eastern Europe, ex-Russian, ex-Soviet countries, Middle East, Turkey. So all these different markets that are not particularly covered by all the payment gateways. So what we had to do is use 5 different gateways. We had to integrate 5 different gateways for Western Europe, Eastern Europe, Middle East, ex-Russia, and United States, or North America, let's say. So it was very hard for us to juggle that, so to speak, that kind of particular operation also from the cash point of view, cash flow point of view. Because they have different payout schedules, they have different commission rates, they have different foreign exchange markups, and it was a hell. So what we thought is we have this Bitcoin and all this blockchain technology right now. Can we do it in a way that people can pay with Bitcoin? But we give the merchants on the other end is fiat money. So from the merchant point of view, nothing changes, but they can onboard our solution and get payments from all over the world. That was the idea. So instead of onboarding 5, 6 different payment gateways for all the world, you can onboard one payment gateway that accepts cryptocurrency payments.
So at this point, you're still an entrepreneur. You're still running.
Yeah, I'm still running the company. So that came out to be an interesting idea, and I assembled a small team to go a little bit deeper on that idea, because what we had in mind was Bitcoin, and Bitcoin was the most secure for payments. But the problem with Bitcoin is it's very slow and it's very expensive, and you cannot have that in payments. I mean, the 2 things that you cannot have in payments, because credit card payments from the user's point of view is free. I mean, you don't pay for credit card payments. The merchant pays everything. You cannot do that in Bitcoin from the technological point of view, because Bitcoin is a push payment system and credit cards are a pull payment system. So we had to change it. And the timing was also a bitch, so to speak. I don't know if I can say it on this interview, but it was. And it took a lot of time and a very volatile time to process Bitcoin payments. So you cannot have that because credit cards are almost instant, you know? And so we created a sort of layer 2 sort of technology on top of Bitcoin that solved these 2 problems. The problem we had was, it was so peculiar, that technology. It worked great, by the way. It was making Bitcoin very fast and very cheap. And it pushed all the fees that are attached to Bitcoin to all merchants. So we changed Bitcoin's particular infrastructure from a push payment to a pull payment. It's great. It's a great technology. But the problem was we couldn't explain it to the merchants. They didn't get the idea. We were way ahead of our time. So what we did was we created a white paper of it, and it is public at the moment. I think it's in Springer or something like that. And we presented the white paper in Luxembourg in CBT 19. It was selected there. It was peer reviewed, and it's considered to be a very, very advanced and very useful technology for the future. And
for the future, though, right? It's too soon.
Yes, we just shelved that technology. So we took some part of that technology and used it in our current technology. Not all of it, but parts of it. Well, the state of mind is the same. So it has to be fast, it has to be cheap, but it cannot use Bitcoin, of course, because it's a volatile currency. Instead of Bitcoin, we now use stable coins to push all these transactions. So that's how the idea evolves. We made a hard pivot in the middle of the road because we couldn't convince merchants to accept and onboard to our system. We talked like to 750 different merchants all over the world and in different sizes. We actually recruited 3 as customers for that particular payment system, but it wasn't going anywhere. It wasn't scalable at the point.
Okay. So what? It's too complex, or it's too scary?
Yeah, it's scary. It's really hard to understand the particulars of it. It's very different than the credit card business, which merchants are very accustomed to. But the timing will come, I think, when the world starts to switch from credit cards to debit pushes to pay for merchants. It's already started in the United States. It started somewhat in Germany, and it is right now expanding to the rest of the world. So instead of using a credit card for a particular, for example, e-commerce payment, instead using open banking or a particular API like Plate, you can push funds from your own bank account to the merchant bank account. So there are no middlemen, there is no Visa, there is no MasterCard taking cuts from that payment. So it's a direct debit payment from your bank account to the other to the merchant's bank account, which is one of the greatest advancements right now in the payments technology, in payment space. Everybody's working on that. Many startups are working on that, and it is going to change the way how we pay for goods online. So our initial technology that I just explained is a good addition to that technology if it goes mainstream, and it will go mainstream in a couple of years. I think it's because it's much better than the credit card system, the plastic card system.
Okay, so you think that so which technology of yours then are we discussing in this context? So this then is a way of using cryptocurrency like Bitcoin, but it's too volatile. But you moved away from that to the stablecoin. Yes. So the stablecoin is something that people can kind of not be frightened by, that people can more easily understand now.
Exactly.
But does this mean that what you're going to do is going to evolve in the next few years as the payments system evolves in the next few years?
No, our vision is to move money around the world as fast as possible. Okay, we are not aiming for a particular vertical. We are not aiming for a particular market. We are not aiming for payments or remittances or any other particulars. Our vision is to move money really fast. And the technologies that we build serves always that vision. And, you know, I'm kind of a Jeff Bezos kind of guy. I'm stubborn on vision, very flexible on details. So how we get there will change over time, because we have to look at what the market accepts and where the opportunities are. But the vision is, and it's a very doable vision, by the way, to move money as fast as we can all around the world, including Africa, including South America, including China, and all these corridors, you know, and that's where our vision is.
So what's the benefit of that? In the simplest terms, Len, you know, I'd say you've got this entrepreneurial background, you were struggling with this issue. So what are the benefits of being able to move money around the world faster?
Well, let's look how the world works right now. You know, in the world there are a little over 2,000 different payment systems, you know, and less than 20% of them are connected to each other. So that's a very peculiar problem. That's a very peculiar state. So let's say you are using PayPal in the United States or Venmo in the United States. It's not connected to M-Pesa in Kenya. You know, it's weird that it's not connected to M-Pesa. You know, because if you want to send money to Kenya, it's going to be very difficult if your PayPal or your Venmo is not connected to M-Pesa. Now you have to go to all these different banks and wait for like 10 days for your funds to arrive at M-Pesa in Kenya. So that's a problem. And the problem extends to our everyday lives, not just sending money, you know? So let's say the next generation of I believe the next generation of social networks are games, right? Like games like, for example, Fortnite or Roblox. You know, already millions of people are gathering on those platforms, and when the VR comes, a particular vertical of people will be living in those VRs, and in Roblox and Fortnite, they will be our virtual worlds in the future. So it's going to be like Oasis in Ready Player One. You know. Let's say you are playing a game. Let's say you are playing Fortnite, and you are gaining some items in Fortnite. Right now, there is no way that you convert those items to anything besides Fortnite. You have to go to an unsecured secondary market to sell them. You don't know their price. You don't know their what's their worth. And even if you sell them in the second market, not everybody has access to those markets, and not everybody has the funds in those markets. So what this will change, moving money very fast on a singular infrastructure will change, is what you gain from Fortnite, you can immediately go buy coffee on your on Starbucks in your corner. You know, you go out, you go to Starbucks, and you buy coffee with your Fortnite's gainings. You know, and that is a very different future that we live, because what we understand from payments is usually when I say remittances or payments to people, what we understand is like $1,000, $1,000, you know, sending around. But 80% of all payments are below $200, you know, $5, $10, $20. Try send $20 from United States to China. It's impossible. It's not doable. Nobody does that because the costs and fees are much, much higher than $20. I mean, the SWIFT itself is $25 at this moment. You know, it's impossible to move money, to small amounts of money around the world right now. So that's what we are trying to change. Could we change it? I don't know, but it will be changed. It's going to be us. I don't know, but it will be changed. It has to change. It makes sense. That's the world we want to live in. You know?
So that means a sort of world where what counts as currency could be almost anything as long as you can trace its value.
Exactly.
Right?
As long as you can value them, as long as they can store the value, and with that storage, you can move it around as a unique asset, the problem can be solved. And
so this means you could have an asset that as you've pointed out, you could have an asset that you win in a game that has a value.
Yeah.
That now that value can be ascertained if this technology develops the way you think or hope. So you have an asset. It has a value in the game, but now you can ascertain a kind of external value as well, which you can then use that to buy coffee or to buy groceries. Exactly. Now, presumably that means you would be able to do this with deeds of physical assets as well.
That's where I was getting at. You don't have to have only digital assets. You can digitize a physical asset, you know, because think about fiat money. Physical cash can be represented in the digital world, and digital cash can be represented in the blockchain. But it also means that physical cash is actually represented in the blockchain via stablecoin. So you have $1 banknote, and it's represented in the stablecoin. So you can digitize everything. You can digitize wheat, for example. So with all of a sudden, you are growing wheat, and you are pushing that wheat without first converting it to any fiat money, and you can go buy a refrigerator, you know, because Oracle says 3 wheat are worth 1 refrigerator, and so you push the digital wheats that are represented in your digital world and buy the refrigerator, because now it can be settled amongst each other. The problem we have right now is our infrastructure are not built to settle everything. You know, the only settlements can take place in the banking infrastructure, and banking infrastructure are very much disconnected from the e-wallet infrastructure, and they are very disconnected from the cash infrastructure.
So how will these things come together? I mean, we can look at what you're working on, which is, you know, this is payments. This is an addition to the banking infrastructure, right? Like an augmentation.
Yeah, it's just an augmentation. So the endpoints that we have in our system are all fiat money, and the endpoints are we only connect financial institutions, the regulated, licensed financial institutions, to those endpoints, because the money comes in from one end and fiat money comes in from one end in our system, and fiat money goes out in a different currency on the other end.
Okay, you know? But what does it take? What does it take to go from that, which seems like just a sort of a relatively small step forward in terms of mindset, right? People accepting it. How do we go from there to being able to buy a coffee with something I've just earned playing Fortnite? What would it take to get all these different kinds of networks and infrastructures to be recognized somehow?
The technical part is not that hard. Because the technology that we needed was the blockchain, you know, especially public. What we needed was the Bitcoin, actually. Okay, now we have Bitcoin. It's great. It's very secure, and we can connect everything because it lives on the internet. Everything that's connected to the internet can also connect to the Bitcoin network. So, from the technical point of view, we have it. We have it. So, what we need to change is the behavioral patterns of people. So, in order to change the behavioral patterns, you have to give value to the. You have to offer value with those changes. So the value, the more change you expect from people, the more value you have to offer them. So I think the triggers will come from the developing world at this point. I believe so. I'm not sure about that, but I believe it will come from because there are two things that why I'm saying that. You know, World Bank says there is a the average remittance fee structure, fee value, commission value is 7%. That value is very much misunderstood by the people. It's actually not 7%. It's more like 2.5% if you calculate all the volumes in it. So that 7% is an unweighted value. So if you want to send money from United States to India, it's like 1.7, let's say 2% at tops. But if you want to send money from United States to Ghana, it's 20%. So what World Bank says is 20 plus 2 divided by 2, it's 11%. That's how they calculate it because it serves their mission. But their mission is all over the world, given any corridor, it cannot exceed 3% in the coming 5 to 10 years. That's what they're. But on average, if you weight it with volumes, there is not much of a problem because from United States to India, the volume is $10 billion, more than $10 billion annually. From United States, Ghana, it's $100 million tops. Okay, so if you weight it, it's more like 2.6%, something like that. So why? Why is Ghana so much 10 times than India? Because they don't have the access as India, they don't have the access to our traditional financial systems. That this disparity, this fragmentation of the financial infrastructure forces them to go for very high fees because they have all this overhead, all these fragmented financial systems, all these problems that they have. But think about how stable coins are or how cryptocurrencies are. They are born in the internet and they die on the internet, you know, and they all live in the internet. So all you have to have is an internet connection. And now you have a connection to the entire infrastructure. Now Ghana can connect to internet because there is internet in Ghana. Now, if you can connect Ghana to the internet, their problems are solved. All they have to do is to accept to deal with stablecoins. You know, they don't need the fiat money. You know, they don't have to do it. So, but that's a big change, big mind shift. You know, from the.
Well, I mean, yeah, that's true. But and also, I guess one of the things that we keep coming up against or reading about when it comes to cryptocurrencies is nervousness of regulators.
Sure.
You know, because and central banks because and the argument I think varies as to why, but the basic idea of like if the function of a central bank, for example, is to try to control inflation, then they would be worried by, I think, not having control over what is considered currency.
Yeah.
I mean, one can argue, of course, that central banks have been creating inflation. One can argue that maybe that shouldn't be the primary function of a central bank. But it seems like the nervousness from say, regulators, governments, central banks seems to be based around the idea of not wanting to let go of control of what currency is and who produces the currency and how it's managed, I guess.
Well, you're right, first of all, but it's going better and better. Central banks and regulators are giving a lot of effort to understand how this new economic system works. And they are publishing all these great papers and reports. The IMF just released a report about central bank digital currencies, and it's like 66 pages long, and it has great insights about central bank digital currencies and stablecoins and how they can interact with each other. And we are at the infancy of this technology. I mean, I don't believe the stablecoins will remain as they are right now. I mean, there is a huge separate decentralized financing coming, approaching right now with all these tokens and transactions without regulators, without mediators, and it is going to be, it will take some time to connect these two and stuff like that. But from the philosophical point of view, there are a lot of ways to keep central banks and all the other banks also involved and connected to this system. And there are several different governance techniques that can be deployed in any kind of blockchain that would give central banks special permissions or authorities, so to speak, to control the inflow and outflow of money. You are right about the inflation, and it's not just inflation. It's all about macroeconomics on how countries interact with each other. Think about it. I mean, the foreign exchange between the USD and the Chinese yuan. I mean, all changes reflect some political move, and all these changes cause those political move. It's a circle, you know. And you have to be careful about when you are talking about replacing fiat currencies with digital. I'm not talking about that. What I'm talking about is a singular infrastructure that many other infrastructure, that's disparate infrastructures can connect to and settle with other infrastructures. Like PayPal doesn't have to change anything. PayPal have to connect to that infrastructure, such as M-Pesa can connect to that infrastructure. They don't have to change their inner workings. But since they are connected to the same infrastructure, now they can settle amongst each other. That's how we are starting right now.
Yeah, right. So right now, it's really about it's not really about creating new money as it is about increasing the velocity of money, moving money around.
Yeah, that cannot be done from scratch. I mean, it's going to take some time and some steps to go from here to there. You cannot just wake up one day and okay, we are not using USD anymore. We are using Bitcoin or any stable coin. That's not going to work. That doesn't make any sense in a mathematical sense either, and a political sense either. You know, like I said, Chinese yuan, USD foreign exchange affects everything, and it has secondary, tertiary effects, you know, to other countries, you know, and it doesn't work like that. I think our approach is the right approach to create a backbone that other people can connect into, you know, so they can communicate with each other, and so that one payment system can settle with the other payment system. That's what we are aiming for at the moment, and I think that's the right way to do it. If we can connect all these payment systems, remember I said there are a little bit more than 2,000 payment systems at the moment, and less than 20% are connected to each other. If you can connect, think about it. If we can connect 90% of them, if 90% of them can talk to each other, can settle with each other, how different in a world would we be living in? You know, that Fortnite payment system all of a sudden can connect to M-Pesa, for example. So a Kenyan citizen, while playing Fortnite, can immediately cash out in M-Pesa and buy a coffee in the corner store. You know, that would change everything. You don't have to replace fiat currencies with digital currencies. That is not our job. That is the central bank job to think about it and how the central bank digital currencies can work.
Well, true. But Joe, the question that occurs to me though is like, let's just take the Fortnite example. So you're playing in Fortnite and you earn I don't play it, so I don't know what's in there, but you earn an asset that's got a value within the game. Well, if you are able then to take that and use it to pay for something, aren't you creating money? Because they have you paid directly for that, so there isn't an exchange.
Are you creating money, or are you creating a security, for example? That's a very particular and a very long conversation.
Oh no!
Well, you might be creating a security and an unregulated security because you all of a sudden there is this asset that can start purchasing things. You know, or you could be creating a currency that doesn't have any backing, any central bank backing. You know. But this is a problem that actually can be solved as long as there is a conversation about it. You know, it's a little bit harder to solve it you are right. You are creating an unbacked currency or an unregulated security, however you look at it. And you are now using that asset that is being created by the game and that is being unique because it lives on the blockchain, and you are settling it with something else. It's basically a barter. So you are bartering, you are not actually creating money or security from my point of view. You are creating an asset that lives on the digital world, and you're exchanging it with coffee that lives in the physical world, you know? And the exchange creates a settlement, and that can be settled in the blockchain as well. And it might have some implication on accounting part on Starbucks, but these are all details about that system.
Oh, I see. So it just shifts the point at which you consider how the value is represented.
Exactly.
It's an accounting problem.
Yes, you have to think about in the first principles, what is actually money? You know, why do we have money? You know, you have to start thinking about like this, you know, why do we have money? Because it's impossible for us to settle with our three beats, I don't know what we call it, with a refrigerator. Or let's say I have two laptops, and if I have to sell these laptops first and get the money to buy a new refrigerator. I cannot just take these two laptops, go to the refrigerator store and buy a refrigerator with these two laptops. That doesn't happen. That's not how the world works. You know, that's why we have money as an intermediary. You know, the values are all attached, and first we have to convert everything to money to buy things with money. You know, that's.
But I guess what you're saying is that if
exchange, you know,
if you were able to exchange directly. So you had a recognized, you had two laptops, you have recognized value for those two laptops, which takes what the initial purchase price less whatever kind of amortization or whatever would be involved, any loss in value in the meantime. And then that value can just be exchanged directly.
Yes.
If you had a system, if you had the infrastructure in place.
You can settle it. If you can settle it in a very secure and trustworthy way.
So this is a potential future that we could see in years to come.
That's like 10 years, 15 years ahead of us.
Well, I'd say, you raise an interesting question there then. So what do you think is going to change in ways that people will notice day to day with regard to payments and money, sort of in the next, say, 5 years?
Yeah. The particular financial infrastructure that we have right now, we are too aware of that infrastructure, you know. The banking infrastructure. We have all these credit cards, you know, that lives in our pockets, and we have these IBANs, you know, or account numbers, all these numbers that are too much in our lives. Nothing works in the background right now. You have to have the IBAN of a person, an account, and the routing number of a person to send money. And there are a lot of security issues, lots of anti-money laundering problems and stuff like that. They are too much in our lives. The first thing that people will start to realize is that all these complexities will start to fade into the background of our lives, especially when money starts to live in the internet, you know, because we all have phones and we will all have maybe the VR glasses in the future, but we all will have phones, and the most important maybe a feature of digital cryptocurrency or a stablecoin is that it can reside and live in your phone. So you don't have anything else. You don't have to have anything else, and it can be transferred. You know, I read patents as a hobby, issued patents, especially by the United States. And there was a patent that I came across, you know, for the security of any cryptocurrency transaction. You have to have keys, a very long keys to secure that cryptocurrency, because it's called an encrypted transaction. Those keys, for example, live one in the phone, one in a piece of paper, and one in the chip of your credit card. So you need two of them. At least there are three keys, and you need two of them to authorize any transaction. So all of a sudden there are these very genius ideas coming from patents and all over the world from startups that isolates the end user as much as possible, and in the user experience point of view, and taking all these complexities of banking infrastructure to the background. The stablecoin will make that, will amplify that like by 10x, 15x, 20x, you know, because right now you have to have these connections to banking infrastructures, all these complex infrastructures, but stablecoin can literally live in your device, in some sort of different hardware, and it doesn't have to be connected to these antiquated infrastructures. It can live on lives on the internet. It's born on the internet. It dies on the internet. Everything happens on the internet. So any device that's connected to internet can store these stablecoins and can transact with these stablecoins. All of a sudden, lots of opportunities, lots of features can be introduced that cannot be done today with fiat money because it's not programmable. And all these complexities can go into the background, and all of a sudden, everything will start to merge, I think. I mean, right now we have these different verticals in the payments market, you know, credit card payments, and is what Klarna does, buy now, pay later. And these remittances, this payouts, for example, Airbnb, you use Airbnb, you have a house, you want to rent it, you go to the Airbnb, and a bunch of people from different countries stay in your house, and when settlement time comes, Airbnb has to figure out a way to send money to your country. Maybe you're in Turkey and Airbnb is in the United States. Somehow they have to have a cheap way to send money to you. And all these things will merge, and you will have probably one wallet to do everything. Right now, you are with all these neobanks and stuff like that. You have to have at least 3, 4, 5 apps that lives on your phone to do different jobs. So if you
so as an individual, then you saying, like, you know,
yes.
I'll have, instead of a bank account as it is now, I'll have my own wallet which has, say, stablecoin in it. But I may also have a bank account. Perhaps there may be some overlap.
Sure. That's your choice. But you will have a ledger, you know, a personal ledger, and everything will connect to that ledger. You might have gold, physical gold, that can be represented in the blockchain. That will be in your ledger. The bank account, they will be in your ledger. You have one ledger that is
with everything in it,
connected to you, and you can do everything from, because everything is stored in that ledger in particular levels, you know. And from that ledger, you can do everything. Remittances, the same ledger, different technology, but you don't know it. Right now, you have to know it. You have to go to TransferWise. You cannot do it with your bank because it's a completely different infrastructure, and you pay like 5x compared to TransferWise. So you have to download TransferWise. You have to learn how to use TransferWise, and you have to use TransferWise for one singular particular job, and it's sending money abroad. And for all the other things, you need another app. You know, maybe you're using Santander.
So it's all these different
user experience, yeah. Completely different user experience, completely different KYC, completely different AML rules. You know, maybe you are using this credit card for something, and you go to the online store and you start using that credit card, and it got rejected. Why? Because they are using a completely different infrastructure, and your issuing bank don't have a contract with your payment gateway that uses with the payment gateway that is being used by your by the e-commerce store. You know, there are 28,000 banks. You know what banking is? It's not about technology. It's a contract business. There are 28,000 banks in the world right now. Do you know how many contracts there are between those banks to make everything work? 1.3 million contracts.
Million or billion?
Million contracts to bring an order to the entire banking system. 1.3 million contracts, and it's a mess. You know, it's not a technology business. That's why when people ask why aren't banks doing this, are they stupid? No, banks are not stupid. They just don't have the infrastructure to do it. They have 1.3 million contracts that they have to honor. You know, they can't do it. They can't look at all these contracts. They have an insane amount of overhead to honor all these contracts. Every particular system that they are going to release needs to honor all of these contracts. You know, not just payments. You know, mortgages and other stuff like that. All the financial tools, vehicles. So That's why this system doesn't have the ability to isolate the user from all these complexities, because it's primarily a contract business. You know, it's a legal, banking is a legal business.
So it's a legal business. So does this mean then that for systems like yours, or for this kind of this new infrastructure to emerge, it has to come from outside, and then the banks from outside the actual banking system, and then the banks, they connect into it or they don't, they use it or they don't. It's up to them really.
That's what my view is. That's for me is the correct way to do it.
Okay, so banks need really outsiders like yourself, relative outsiders like yourself, to come in and come up with a solution that they can sort of plug into.
Yes.
Because they actually don't have, they just don't have the bandwidth, if you like.
Exactly, especially the big
to be able to do it.
And I mean, they have very profitable businesses. Why should they do this? You know, they don't have the motivation to do it. Also, if it's done, they will be able to connect to it, because that's where the users are. That's where mainstream is going. And if it's easy to connect, if it's easy to integrate, why shouldn't they? They would. But from it's a very different thing from integrating to a known system and building that system from scratch and onboarding all these other players that are needed to work the system, to operate that system.
But I guess right now,
it's done by the fintechs, and the banks will be laggers, and they will connect to those systems that has been created by the financial technology firms like us.
So when do you think the tipping point's going to be with this? When people will be, when, you know, say as individuals, we will all be aware, not you because you know all about this, but people who know less will be aware of how blockchain transactions, not just using blockchain transactions through their bank, for example, which they might not know, but to the point where they actually realize what's going on and realize what the technology is. How long do you think it will take before, you know, it actually, within the public consciousness, we all kind of know?
Actual effects that we will see in public will, I would guess, 3 to 5 years that we will see the actual effect, because before we can see them, we have to get the infrastructures right, you know. But the signals to do that, to accomplish that, are coming from regulators. The controller of the United States, the OCC, Office of Control of Currency, I think that is the regulator of the US dollar, basically, and all banks for that matter. So the OCC is, the head of the OCC is the ex-head of legal at Coinbase, which is one of the biggest crypto exchanges in the world. It's a US exchange. So right now, two things happened in the United States. It's important that it happens in the United States, because the United States basically controls the entire financial infrastructure. You know, they can cancel your access to SWIFT. They can put a lot of embargoes to different countries, different people. You can go into OFAC list and won't be able to transact in the financials, etc., etc. So it's important that the United States embraces crypto technology. So there are two signals that happened within the same month, so to speak, that the OCC greenlit banks to hold cryptocurrencies. You know, that is a big thing, you know. So you have a US dollar checking account. Now you will be from the regulation point of view, you will be able to have a Bitcoin account also in your bank account. So you remember I talked about the ledgers. You have one ledger in your name, and there are different accounts. Now you have Bitcoin and the checking account and the savings account. Now that opens a lot of doors that people don't realize. That opens a lot of doors. So banks are all of a sudden, US banks are allowed to be custodians of digital assets. Right now, there are not many digital assets that the bank would use. Maybe Bitcoin, but particularly stablecoins, I would guess. But in the future, that opens a lot of doors to the future, because you can digitize everything like we talked about, you know. So that was one thing. The second one is that Kraken got a state banking charter. So Kraken in the United States is now a bank. It's a state bank. It's not FDIC insured at this point of time. it doesn't have to be because it doesn't, it's not involved in fractional reserve banking. So it's not taking deposits and giving out a part of the deposits. It's just holding everything in one single bank. But it's a bank, and it's a big thing, issuing a banking charter in the United States to a cryptocurrency exchange. Now that changes everything. You know, now a cryptocurrency exchange is a bank. Now they can bank people in that state, in Wyoming, and do the entire crypto exchange operations in the same entity. And that will pave the way to create new financial products that we haven't seen before, that we have thought before, but we haven't created before because it wasn't allowed. You know, now Kraken has the ability to do that. Now I'm hearing other exchanges to go for other states to push for a banking charter to follow the steps of Kraken. Now the signals are coming, and the signals are very good signals, and it will have these two events that we have just talked about will have great implications in the world, because like I said, the United States basically controls the entire financial infrastructure in the world. So
so once they embrace it, then it starts to spread.
You know, we are at a whole new level right now.
Okay. So I guess in a way we're seeing this sort of classical idea perhaps of it's been several years now of this kind of slow, linear, steady development where you get a few people in the know, then a few more people in the know, a few more, and then at some point with enough of these catalysts that probably something will happen, it will suddenly take off. Well, as you say, we'll see these financial products exist that don't exist yet.
If it starts slow, then it will happen all of a sudden. All of a sudden, we will be, all of these new technologies, all of these new financial products will be coming at us, or that lives in your watches, that lives in your currencies and digital assets that live in your VR machine and stuff like that. And that will change everything once the public is securely, privately, and compliantly exposed to those technologies. And that's what we are working on right now. First, we had to get the infrastructure right, and we are working, everybody, not just us, everybody is working really, really hard to get it right and to make it useful. Because at this current stage, what are stablecoins are useful for? Nothing. That just on-ramp tools, so you can buy Bitcoin from the exchange that you want. So yeah, that's the only thing basically that they are useful for right now. Okay. And in a non-regulatory way, non-compliant way, they are being used in the black market to exchange for goods, like from between Russia and China, and but that's it.
Okay, but the point of this is basically to bring it into the mainstream, so it becomes something that is used as.
So everybody can have access to them in a compliant and a secure way. You know, you can't expect people to get on board with stablecoins and understand all the technical intricacies of stablecoins, so they don't lose them because they forgot about their 12-word key. We cannot let that happen. That's why we have FDIC in the United States, so we can insure their money in case something happens, the bank goes under or something like that. And so we need a lot of systems like that, and a lot of levels of security and privacy for this technology to go mainstream to the average people, you know. And that's what we are.
But this could be a good step, and it looks as if you're making some progress in getting this up and running.
Are working on the speed of the infrastructure and ubiquity of the infrastructure, and other people are the RegTechs are working on how we can make it more compliant, and Microsoft is building a complete suite of digital ID on top of the Bitcoin network. You know, Microsoft is doing that. The giant company, you know, and they have an entire department, and they've been working on this for the past 2 years. And a digital ID, like I said, there's going to be a ledger, but that ledger needs to be checked every time you want to make it, whether it belongs to you or not. And the best way to do it is a digital ID that lives on a very secure blockchain, and which is Bitcoin is the most secure blockchain. That's why they are building on top of it. So there are a lot of companies that are working on different sections of this infrastructure, and once it comes all together, and it will take 3 to 5 years before it comes all together, I'm guessing. I'd say it's 3, but let's be on the safe side and say 5. But when it comes to all together, it will happen very suddenly. People will be exposed to all these different financial products that doesn't exist today.
Okay, so if people are interested, like watching this, they're sort of interested by the ideas, not sure where to find out more information, would you recommend any particular kind of information sources, websites or things for them to check out, maybe?
I'm basically following crypto Twitter, but you have to sift through a lot of bullshit in crypto Twitter to get to the real information. And I always triple check information that I see there, because I don't trust most of the information that I see there. But there are no, I don't think there's one particular source that is very good. Maybe CoinDesk may be good, but I usually go for regulator sites because they are the greatest source of information. Like FCA.
Regulator sites. So actually go like to the FCA website, for example.
So I check out, for example, who gets what EMI license. If there's a crypto company that got an e-money institution license, which is the second biggest charter license in the European Union after the banking charter. So Aave, there is a decentralized finance company that just got rewarded an EMI, which is very interesting for a decentralized finance company to get rewarded by with an e-money institution license by the FCA. We are very curious about that, and we are very excited about that for us too, because we are going for the EMI license too. So that's what we are going for. But the crypto Twitter is good if you know what you're doing. But other than that, it is currently all these what we've talked about is not covered by the mainstream media. So you won't be able to find it on TechCrunch or Forbes or even Wired. They don't write a lot about that stuff. So you have to go fringe a little bit.
Okay, well, good advice. If you're interested, you have to go deep, and you have to go wide, and you have to check your sources as well, yeah? Okay, so just for anyone who wants to keep up with you, I mean, we're running out of time now, so just wrapping up, but to keep up with what's going on at ARF and so on, I'll put a link to your website in the description box below.
Sure.
And yeah, thanks very much for your time, Berhan. It's been very interesting. And hopefully we'll get to talk again, a few months or year or so down the line to see how you've got on, and good luck with it all.
Great, man. Thank you.
Great. Thanks for your time.
You too.
If you made it to the end of this video, why not leave a comment or a question in the box below? I'd love to know what you think about some of the topics we've discussed here today. If you enjoyed this video, please consider liking and sharing it. And do subscribe to the channel if you want to stay up to date with all my videos as they go live. Thank you so much for watching, and stay curious.